When oil supplies through the Strait of Hormuz were disrupted, the standard economic forecast was grim. Analysts expected a major global shock, high prices, and an energy crisis that was only just beginning. However, the market settled far faster than the models predicted. Following a U.S.-Iran Memorandum of Understanding in June, the anticipated disaster failed to materialize. Looking at the trade data, a specific shift in Asia coincides with this stabilization. This chart shows Chinese crude oil imports dropped by 45%, removing roughly 5 million barrels per day from global demand. This single reduction was larger than all global strategic petroleum reserve releases combined. Historically, a drop in demand of this scale is only seen during a deep economic depression or a total societal lockdown. Yet at this time, China was not in a depression, and it had not reimposed the strict quarantine measures seen in 2022. China effectively removed 5 million barrels of daily demand without suffering an obvious domestic economic shock. Why they did it and how they managed it remains unexplained by current market data. One explanation is that this was a natural response to the energy transition. Under this theory, China is simply reaching a point where it no longer requires the same volume of foreign oil. There is evidence of a long-term move away from oil. China currently leads the world in electric vehicle sales and manufacturing, with a standardized production scale that significantly reduces its reliance on traditional fuel. But the timing of the June drop suggests something other than a natural transition. If this were a standard market response, China would have resumed buying as oil prices began to fall. Instead, the imports remained low. The scale and duration of the pullback point away from organic demand and toward a top-down policy decision to stop purchasing. A second possibility is that Beijing relied on its own internal reserves. By drawing from these massive, industrial-scale stockpiles of diesel and gasoline, China could have maintained its economy while cutting off imports. By stepping back from the market, China prevented the supply shock from driving prices to a level that would have broken Asian and European economies. Protecting these regions fits into Beijing's broader goal of building trade networks outside of the United States. A total collapse of the Asian economy would have directly damaged China's long-term efforts to diversify its trade. In this scenario, the import cuts were a calculated move to protect non-U.S. supply chains and maintain regional stability during the crisis. A more speculative theory suggests the withdrawal from the oil market was part of a private diplomatic agreement between the world's major powers. The timing of the cuts coincides with high-level talks held in Beijing by the Trump administration. While no major public announcements were made at the time, this was the exact moment China's imports began to fall most aggressively. This has led some to theorize about a broader geopolitical exchange, where the United States might concede certain regional interests in exchange for China's support in stabilizing the energy market. There are signs of a shift in U.S. focus. During the crisis, the U.S. military transferred significant assets away from the Pacific theater and back into the Middle East to strengthen defenses against Iran. While there is no direct evidence of a secret deal, the alignment of military movements and trade data suggests that China's oil demand may have been used as a lever in high-level negotiations. Regardless of the motive, the resolution of this crisis has significantly altered the geopolitical landscape. Iran is a primary winner. They did not have control over the Strait of Hormuz before the disruption, but they have emerged from it in a position of dominance over the region's transit routes. Conversely, the Gulf states and the broader producer groups like OPEC have seen their influence diminished, with Saudi Arabia appearing particularly impacted by the shift in market dynamics. There is also a human cost. In the Global South, the initial spike in energy prices led to higher transportation and food costs, creating a period of severe economic strain for millions of people. For years, the West believed that while China dominated renewable technology, the West maintained dominance over fossil fuels. This crisis demonstrated China is effective in both spaces, influencing fossil fuel supply chains as aggressively as green energy. This event has revealed a shift in global leverage. China has proven it can move the global oil market, not by increasing production, but through its ability to suddenly and massively withdraw its demand.